Once again, American markets closed because of the Thanksgiving holiday, but the TSX rallied higher today, driven by gains in the technology and energy sectors. Our next guest says, or does, favor Canada and the U.S. over other markets for the next year. Let's go to Brent Joyce, Chief Investment Strategist, Managing Director at BMO Private Investment Counsel. Thanks for joining us today.
Good afternoon, Marilla. Good to be here.
What is pushing the TSX higher and higher this week?
Well, certainly financials have been helping. We'll get reporting from all the banks next week. Energy's been a decent story here in Canada, but globally it's been a bit of a laggard. Year to date, the TSX has really been a market darling. You talked about the deficit story just a minute ago, and some of the inflows on the financial side certainly are going into Canadian stocks and bonds.
Okay, let's talk about whether or not, after the volatility that you saw last week, you are keeping any money aside.
Yeah, the last week's volatility, I think, is very healthy. Rotation from some of the sectors that have been the market darlings for the better part of a year and beyond. It's interesting on a day that's filled with football on U.S. Thanksgiving. We could talk a bit about some of the underdog sectors that have not performed in this three-year bull market run. It's made us a little more constructive on the AI trade and the AI adjacent trade. They were getting ahead of themselves. I still think that you need to be discerning there. And what was very healthy through that is the behavior that we saw for things like Oracle versus things like NVIDIA. And investors being a lot more disciplined in looking at where are the profits going to come from, who can monetize this quickly, and who's got the debt. And that certainly was Oracle's story.
Okay, so do you feel then investors, as you say, are beginning to be a little bit more discerning and beginning to pick winners and losers?
Absolutely, and that really is part of our theme for 2026. It is a constructive view, but we're certainly realistic based on how far we've come with equity markets over the past 3 years. We're not in the camp that people are talking about excessive returns or exuberant returns. The market, I think, has been justified by a lot of earnings growth. And so we think about the areas of the market that maybe need to cool a little bit or grow into their earnings. There's been areas that earnings have well justified the advances in share prices, and including some of the pockets within AI. Cautious not to straight line extrapolate some of those earnings expectations all the way into perpetuity. We need to stay disciplined, and the market action over the past couple of weeks gives me comfort that that's what investors are doing. And then, as I mentioned, we can look at some of the dark horse sectors that have not participated. So this notion and the language of, it's been a rally in everything, I push back on that. It's been a rally in some things and not others.
Okay, so let's talk about we'll talk about first AI-related, because I'm wondering if you see more AI-related stocks getting pushed up next year. If so, where could that go? Before we talk about sectors that have widely been ignored. So what do you think for 2026 where AI will push?
Yeah, I don't think we are facing some sort of a calamity in the AI space. I do think it is a softening or a flattening of the trajectory for some of these businesses. A recognition, realization as to where the next leg goes, whether that is in the software space. We're also thinking about now, after 3 years, where is the deployment going to be? The innovation stage is ongoing, and there's been lots of excitement there. But really, for general purpose technologies, all the way back, to the steam engine and through on to the first internet revolution, the big uptick for society and for markets, equity markets, beyond just those that innovate, is how does that productivity get transmitted to everyday run-of-the-mill regular economy? And that really, I think, is the exciting story that stands for AI as we look to the future. And it's really a part and parcel of a broadening out as to the deployment of AI across regular businesses from what we might call the old economy today.
Okay, so let's talk about what has been sort of largely ignored and where you see perhaps some catch up for next year. What are the sectors that you see perhaps closing the gap in 2026?
Yeah, so we look back on the past 3 years. One is to remember the starting point matters. And so we did have a lot of areas of the market coming out of 2022 that were deeply depressed. Everything was pretty much on sale. We had a bear market in 2022. And so then it is a question today as to who's participated and who's maybe over participated a little bit, where there could be some pockets of stretched valuations, and then those who have not. And the list of those sectors that have not participated would be healthcare. Despite GLP-1s and all of the advances and aging demographics across the world, the global healthcare sector has posted about a 4% compound return over the past 3 years. That doesn't even keep up with the bond market. We've got things in there like energy. And certainly pipeline stories this week in Canada. The Canadian energy has performed better, but on a global basis, energy has been pretty flat for the past 3 years. Now, oil prices certainly have been down on the mat. Seems as though there is inflation everywhere except in oil prices. That's great for the consumer. We're not thinking about oil prices that need to be $20, $30, $40 higher for energy to perform. It's a question of if we see some reflation in the global economy next year, all the government spending, households stay reasonable, business spending that continues to flow, then $10 or $12 or $15 up in the oil price isn't going to upset the apple cart for inflation or the consumer, but it certainly would be a shot in the arm for the energy patch, and it is cheap on a global basis.
I do want to get you...
Another one that we can look at is real estate.
Okay, go ahead, sorry.
Yeah, the last one really to talk about there would be the real estate sector. And again, there are plenty of good reasons why these sectors have been downtrodden over the past 3 years. Really, the key is to ask ourselves, is that negativity about to lift? And by how much? And I think we're looking at a situation here where we don't need a lot of negativity to lift off of these three sectors in order to see the baton hand from other areas of the market that probably need to slow down and take a breather.
All right, I do have to leave it there. Brent, I'm out of time with you. Brent Joyce, thank you for your time. Brent's Chief Investment Strategist, Managing Director, BMO Private Investment Counsel.